I've just created a free Telegram channel to share my investment ideas. Link is in description and comment section. See you in there. Warren Buffett turned Berkshire Hathaway into one of the most successful investment companies in history. But how did he do it? What was his investment strategy? Let's go through and learn them together, the Warren Buffett's 9 steps checklist, so we can apply it to any stocks before we invest in it. Step 1. Understand the business. The first rule is extremely simple. Buffett only invests within his circle of competence. For example, he only invests in companies he understands how they made money, and if he doesn't invest in it. For example, Buffett invests in Coke because he drinks Coke and understands the business that Coke sells beverages and owns many other consumer brands as well. Another example would be Apple, where Apple's business model is selling Apple product but captivating customers with its ecosystem. But wait, how do we find out how does the business make money? First, go to Yahoo Finance and then type the stock that you are interested in and then click on Profile, and then you can read the description of the company. Or, the second method, which I prefer it more, using of AI by asking of ChatGPT for how a business makes money in simple words. So before Warren Buffett looks at the stock price, he first asked, what does the company sell? Who are its customers? And will people still need its products 10 years from now? Step 2. Moat of the company. You'd be asking, what is moat? Moat is the competitive advantage of company protecting itself against its competitors. For example, it is like a castle protecting the princess from attacks, and it is split up with 6 branches of protection: strong brand, cost advantage, network effects, intellectual property, switching cost, and scale advantage. For example, Coca-Cola's moat comes from its strong brand, global distribution network, and massive scale. Consumers recognize and trust the brand, while its products are available almost everywhere. This gives Coca-Cola pricing power, lower costs, and an advantage that is extremely difficult for competitors to replicate. But there are 3 classifications to moat. A wide moat means a company has strong, lasting advantages that are difficult for competitors to copy. A narrow moat means it has some advantages, but competitors may catch up over time. No moat means there is little competitive advantage, making it easier for competitors to copy the business, take customers, and pressure profits. Which is why Buffett looks for great companies with wide, durable moats that can protect their profits and compound value for decades. Step 3. Look at the numbers. But what kind of numbers? You'd be asking. The financials. Go to the Yahoo Finance, type the stock that you wish to look for, and then click on Financials. And then we focus on the revenue and make sure it is increasing consistently yearly. Net income as well, increasing yearly. Next, we move on to the balance sheet and making sure that the total assets is more than the total debt. And then we move on to cash flow and making sure that the ops, cash flow and free cash flow is increasing yearly as well. And that is on financials. Step 4. Look for high returns on capital. We can use Yahoo Finance, which is the hard way, because we got to manual calculate the financial ratios, or we can do the easy way, that is using Guru Focus. For example, type the stock that you are looking for, and then the financials ratios pops out, and some of the ratios to focus on would be ROE, ROIC, debt to EBITDA, current ratio, PE ratio, and dividend yield. But that is depending on the type of company. This is a guideline that I use for comparing companies when analyzing them. Step 5. Check the debt. First, you'll go to Yahoo Finance and type in the stock that you are looking for, and then go to the financials. Next, you go to the balance sheet and scroll down and open up the current assets and make sure that cash and cash equivalents, which are pure cash or short-term assets that can be turned to liquidity, is more than the total debt, and in this case, Nvidia cash is more than total debt for 5 years consistently, so it is a very good case. Bad case example. For example, GM, General Motors, we can see that the cash-to-debt ratio is very low, where the cash is stagnant for years, while debt is increasing consistently throughout the years, hence explaining the stock price. Step 6. Check on the management. Imagine the company generates $10 billion and beats its latest earnings by a mile. What would good management do? Good management would reinvest into it, like buying another company to expand its market share. Repurchase the stocks, pay dividends, or reduce debt. Good management loves the company and treats it like its own, with the mind of expansion and putting the company number one in its sector. But what if it is a bad management? They would destroy the company by wasting money, doing bad investments, and increasing the problems in the company and running it down. Hence, this is why Warren Buffett looks at management and only buys stocks that has good management. So I created an AI prompt for to find out if the management of company is good within the last few months. Let's try it out. Let's take NVIDIA to test the AI prompt out. And as we can see that the AI prompt works well with showing the recent earnings and the actions that management is taking with a scorecard of management, such as shares buyback, acquisitions, revenue growth, and finally, with its main concern of the stock. Everything in one single prompt. Step 7. The stock price matters. Sometimes, when I found amazing companies, I don't always buy them immediately because price matters. Because amazing companies does not equal to amazing investment until you enter at an amazing price. So amazing company enters at amazing price equals to amazing investment. So we look at the PE ratio to know when to entry. For example, NVIDIA current PE ratio is 33.32 and the medium is 52.81. And we can see from the chart that it is still on an uptrend. Another example would be Palo Alto, which current PE ratio is 294 and the medium is 114. And from the chart, we can see that it is quite overstretched too. Low PE example. For example, Netflix currently has a low PE ratio, which can be seen from the chart with large pullback and small rebound. Which is why I like to buy amazing companies at a low price and when people are fearful. Step 8. Buying with margin of safety. In short, it means to buy in tranches. For example, NVIDIA stock, if you all in at 219 and it pulls back, you have no margin of safety for it. But if you buy in tranches and at support level, you have margin and safety and lower stock price due to averaging down. Step 9. Can I hold it for years? Before you start getting excited and randomly buying any stocks you think is good, you gotta ask the question, can this stock be held for years? Would the company still be here 10 years from today? For example, the Mag 7 companies was still around 10 years ago, which I do still believe they will be 10 years from today. And that is Warren Buffett's 9 steps checklist before he enters any stock for investment. I've just created a free Telegram channel to share my investment ideas. Link is in description and comment section. See you in there.